This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
In the movie series The Matrix, they didn't really emphasize the economic growth of the engines that led to that dystopian world. This week, I'm going to look at the economy as it sits before us, as well as the awesome growth in spending behind the new economy up there in the clouds and the unleashing of artificial intelligence. Welcome to the Wise Investor Show podcast. I'm Chase Henderson, and I'm going to start off quickly with an underreported but really important bit of news that struck early Thursday morning. It's just not as exciting as everything else this week, but we did get the July reading from the National Association of Purchasing Management, who runs and released their Chicago PMI data for the month. And although the reading was 47.1, and that's still a reading obviously below 50, and therefore that's still a warning as such of a contraction in that type of spending, it was a far better reading than the consensus estimate, which according to FactSet was for a reading of 42.5 and far better than the previous month, which was a reading of 40.4. And that is a great trend. And if it continues to improve and soon shows us readings over 50, well, that's a big reversal because this gauge has actually been giving us readings under 50 for almost 2 years now. But there's a lot of noise in the data right now, and there's definitely been a pulling forward of some orders in the economy, as we did see lots of firms try to get ahead of tariffs with their spending. And although inventories is part of this readout, it also may give us some head fakes here. So let's really see if we can get a couple of more months, maybe get a couple of months in a row above 50 before we declare that manufacturing activity is actually accelerating in the U.S. But it's a good sign. The other option here, though, is that while this is historically considered one of the more important, the more reliable leading economic indicators, perhaps for various reasons, maybe it's just that much less important. Perhaps because it is regionally leveraged and things have geographically shifted. That there creates a bias to some industries over others, while the overall economy may do very well. Or perhaps it's just falling behind, not in its accuracy, but its importance in that reading as a gauge of our overall economy and as a predictor of the markets as they lie ahead of us. Or maybe, and this is the most likely, is that it's still a pretty good indication of what many sectors are doing and are going to do. But for the overall stock market, maybe that doesn't matter as much anymore, as the market itself is largely defined by and led by the technology sector, along with a few other contributors, as the indicators like the PMI may be telling us what the typical U.S. company is doing. But the companies that dominate the weightings in the index, in the indices, and themselves, well, they amount to trillions of dollars in value, and that's what's really defining the day right now. That's been the case in the markets for years now. It really does seem that tech has led the way for quite a while, but it's that much more pronounced this week, as according to the data on FactSet as of July 29th, the S&P 500 is up around 8% for the year, while the equal-weighted version of it, this very same 500 companies, but evenly weighted, that's up about 4% for the year. The S&P 500, if you exclude the technology sector as a whole, well, it's just flat. It's up about 1% for the year, while the tech names on their own, if you exclude the tech names and just measure them, they're up over 20% for the year. Now, I don't know that there's just one lone conclusion you can draw from all that. You can throw caution to the wind. Your takeaway from that could be, hey, let's just invest largely, if not solely, in the big tech names. And if you did that up to till today, you'd be pretty happy recently. Plus, if you believe in indicators like the PMI and that they're still pointed towards manufacturing, at least contraction, well, then you may conclude that you should be cautious with the other sectors in the economy. Those that don't talk about AI in their conference calls, at least not as much. Well, then again, if the PMI is trending in the right direction and it's going to get back above that 50 reading and those other sectors are trading at historical discounts to their modest earnings expectations, well, then maybe they're going to get a valuation boost and earnings surprises to the upside, which combined will drive some handsome returns going forward. So that would be kind of the contrarian, certainly more value-oriented approach there. Now, I'm not drawing any conclusions for you here purposefully. I'm just trying to provoke some considerations, and maybe we'll ultimately just resolve to take a balanced approach, owning the best of the names that are driving the indices, as well as those companies that are really top names, they're really well run, that are trading at pretty discounts in the more boring sectors right now. But here's one other consideration. According to a report from Stanford, in 2024, overall private investment into AI in the U.S. reached $109 billion for the year. And that has likely, and I think from what I've seen since then, very much has been eclipsed this year. But per the report, which included corporate capital expenditures, kind of big investments from the big tech names, the total AI-related investment in the U.S. is projected to exceed $300 billion total into 2025. And that number, the total corporate capital expenditure, that version tries to capture everything, including spending on the data centers, the energy spend, the labor spend. And this may be compared with the spending back on the internet boom in the late 90s, where in 1999, spending peaked at about $105 billion for that year, or if we adjust for inflation, about $200 billion in today's dollars, although that figure may leave out some of the additional spending that I tried to incorporate here. It doesn't include money that was spent on surplus fiber. We really don't talk about fiber that much anymore, but surplus fiber and servers and all that hardware and such, much of which, a lot of it never even was utilized at all, just went to waste. And that's why I'm also urging some caution when drawing the comparison here, because while a great deal of that spending in the 90s was on these kind of dot-com startups and a lot of it turned into dust, or it was spent on hardware capacity, which was overbuilt and also a large waste of capital, today's AI spend is apparently more strategically focused, and it is controlled by a fewer amount of names, a few dominant players. So that it's a bit more compelling that it has legitimacy, at least, than some of the fluff we saw back then. The revenue models are already shaping up and demonstrating real capability, but still, it at least has some echoes of that dot-com era. And the scope of the dollars that continue to be spent at times has to be considered, at least, in terms of the ability to see a return on that massive investment. It's amazing to see hundreds of billions of dollars in capital spending, but if you own these companies or you're running those companies, you want to see that money give you a return. And the markets are sure right now rewarding them with returns on their stocks, with equity premiums, but it's a steep, maybe not unsurmountable, but a steep hill to climb to really see a lasting return in both revenues and ultimately earnings for the scope of this capital. Let's resolve to just keep a level-headed approach with these names and add common sense, and continue to strike a balance when we commit new capital, put it at risk in these markets as the markets overall continue to make new all-time highs right now. That being said, I'm going to take a quick break, but when I return, I'm actually going to dig a little bit into the results from one of those very names and talk more about the scope of its capital spending and why we may very well see a legitimate return on that. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Higher inflation and higher interest rates could be coming, but bonds are still beating stocks so far this year. How should we think about positioning for stability and cash flow in a more volatile world? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Before I dig into a stock here, I wanted to briefly mention some other relevant data points in this past week. There was a lot of news this week. There was the Fed meeting, and their results were completely telegraphed. There were some trade deals just about closed and another one that's been postponed. But not to be overlooked on Thursday, which was also what we got was the so-called Fed's favorite measure of inflation. We got the PCE deflator number, which rang in the core reading with a 2.8% inflation reading. That's a bit higher than the consensus estimate and equal to the previous period. And then we got the headline reading, which was 2.6%, lower than the core reading, but that was also above estimates and higher than the previous period. And it's also a reflection of why the economic world likes to use this core reading, because food and fuel, the cost of it matters a lot to you and me, but there's a lot more volatility in those numbers. You get non-economic influences that kind of move them artificially for periods of time. You get acts of war that moves the price of oil. You get disease outbreaks that affects poultry prices. The core rate also cooks in some of those numbers, so you don't want to double count them. So as that pours over other areas of the economy, most people generally look at the core number. Anyway, worth noting, as we've had kind of a prominent lobbying effort for the Fed to cut interest rates, but we had a decent GDP print. We have pretty low unemployment, and inflation kind of sticking around a bit. The data here just doesn't suggest to economists that the benefit overall would be to cut interest rates today, not unless you're particularly interested just in the cost of borrowing alone. Now, preliminary GDP numbers for the second quarter did come out also on Wednesday. They were ahead of expectations, but actually the overall run rate was a bit low. If you do factor in a year over year and you look at previous quarters, we're still running at a basically sub 2% growth rate. But if that PMI data that I mentioned earlier continues to move and point in the right direction, well, then maybe we will see that GDP number pick up a bit. It's hard to argue, though, that you can't argue that the economy is on fire and then say that the Fed should cut interest rates. So we have to either logically admit that the economy needs some additional support or leave well enough alone here. And what is well enough certainly seems to be big tech, as I was saying. And one of the names that's kind of singing within this space is Microsoft. And I don't know how we started down this rabbit hole this week, but in the office, we started looking at if we could find anything that has outperformed Microsoft since 1991. And we got to that point because I graduated high school in 1991. And to some of you listening, that may seem to make me young somehow, but that is actually 34 years ago. And one of my colleagues kept trying to find any name that over that span that outperformed, and we actually didn't find anything because $10,000 invested in Microsoft in January of 92, which is kind of where I drew the line, would equal almost $3 million today. For comparison, if you put $10,000 into the S&P 500 at that same date, it would be worth a pretty handsome $155,000 today. And if you put $10,000 into Berkshire Hathaway, the A shares, because B shares weren't out there at that point, well, that was really impressive, $800,000, substantially more the S&P 500. But Microsoft kept doing it, and over the time frame, they've evolved. They've created new markets for themselves, new purposes and applications to be selling, and then continue to go on and become the dominant player in those spaces. They actually, believe it or not, they go back further than my year of high school graduation. Microsoft actually goes back to 1975, with actually some earlier roots before that. They went public in 1986. That's the last time the Mets won the World Series. But here we are in 2025. Mets are looking pretty strong this year. And Microsoft now is, as of this week, at all-time highs with a market cap of just about $4 trillion. And before I go any further, I should and need to disclose that I certainly do own shares in Microsoft. Unfortunately, I don't own them since my high school days, but I personally own shares in it, and we do own shares in it for our clients. So it's a stock at which I am biased to the upside. And I'm going to try and include some other opinions here, but I bring it up today because they just announced their fourth quarter earnings this week. Despite it being July, they're on that offset calendar. And they beat the FactSet consensus estimate for both earnings and sales, and they provided forward guidance that came out ahead of the previous street estimates. Now, most of us at work, or wherever the various general we work, still have some form of Windows operating system running their computers. And within that, on their computers, many of us use Microsoft's Outlook to manage our calendars and such, and certainly our emails, and a handful of other Microsoft applications. But what really drives Microsoft's growth today is certainly front and center their cloud business, which now is linked up with and leveraged to the AI business, or their association with the AI business. And that cloud business now is poised to become the primary source of revenue. It's starting to, this year, looks like it might actually eclipse that previous applications business. And they guided on their conference call that in the current quarter, the so-called Intelligent Cloud Division should grow revenues to over $30 billion for the quarter, which is a year-over-year growth rate of 37%. And according to FactSet, the street had previously estimated already a pretty handsome rate, but the street had their estimates at 33%. Currently, the forward consensus estimates for earnings are for over $15 a share in this current fiscal year, then over $18 the next year, over $21, and then $26 a share in fiscal year 29. And that puts them at 35 times this current year's earnings estimates. And that's a pretty steep premium over the S&P 500, which is no cheap number itself. S&P 500 is currently at 23 times the forward earnings estimate, also at a premium over its own 5 and 10-year averages. But in response to their earnings, over at Goldman Sachs, their response to the quarter was that, quote, the quarter increases confidence in sustained AI-driven growth and market share gains, end quote. Remember, I hinted it earlier at how these AI spending patterns kind of echo the late 90s internet boom, and also how they're not the same. Oh, well, Goldman here seems to be saying that the evidence is gaining strength. Their report actually went on to say that, quote, this quarter helped validate our thesis that AI percolates up the stack. The ripple effect of Microsoft's GPU compute leadership drives demand for their wider suite of higher margin products, which uniquely cover all layers of the tech stack, end quote. And then they reiterated their buy rating and raised their price target on the stock to $630 a share. I'd love to also here include what they put at the bottom of each report, their risks to their thesis. They have a section that says, risk to the stock thesis. But it really was kind of a weak pro forma effort, simply saying, in not so many, or not as many words even, that what could go wrong with this thesis is that, well, of course, if cloud spending slowed or if there was an overall slowdown in IT spending, it would be bad for the stock. Well, I think that's obvious, but they're certainly not predicting that. So keep an eye out for that. Over at Wedbush, they pointed to Microsoft's CapEx growing to over $30 billion for this quarter alone. That's over $120 billion expected in CapEx spending for the year. And they went on to say that, quote, with every $100 in Azure cloud spending, they drive $50 in additional AI revenue to the company each year, end quote. So they are actually trumpeting this huge CapEx spending as well applied. I said earlier, it's hard to guess if they're going to get a return on this capital. Well, they said they get a 50 cents on the dollar return annually So it's wise to therefore spend as much as possible if you can get that type of return. They actually went on to say that, quote, they believe the next phase of AI monetization has just begun, end quote, which is an idea I can get behind, but also, quote, with enterprises increasing AI budgets and collaboration in fiscal year 26, see the full extent of the growth story underappreciated, end quote. Now, I am not fully doubting that. It's just hard to come out and be as bold to say that the AI story is underappreciated after you see it discussed pretty much every day, and the companies that are so strongly and narrowly behind it making such tremendous gains. So if it is underappreciated, well, it's already unprecedented. So it'll be something to behold. Microsoft continued to make new highs after these earnings on Thursday, and they were currently trading at about 35 times earnings, as I mentioned. But that's versus what was a 5-year average. So they don't, this isn't a stock that historically trades at a discount to the S&P, but 5-year earnings average of 30 times. They have traded at a high over the last 5 years of 40 times earnings. And 94% of the analysts following the stock have it rated a buy currently, according to FactSet. So, it is a story right in the bullseye of what is absolutely working today. The evidence seems to point to it working even better, and the street seems leveraged to that thesis. So as I said earlier, personally, I'm also leveraged to that thesis, so be careful with what I'm saying, and continue to carry the stock. But when there's not a lot I can say bad, nor really can I legitimately go out there and find many people out there printing much bad about it, let's at least be wary of overdoing exposure at these levels. The fear of missing out, chasing it, buying it at all times. I remember when the first stock, which wasn't Microsoft, first time reached $1 trillion valuation. And I heard more than once from more than one person that there was nowhere really for it to go from there, as if it was this kind of artificial glass ceiling on valuation, an absolute level that we just couldn't imagine any given enterprise growing beyond it in value. Well, today there are 9 or 10 public companies that are worth over $1 trillion, and now we have 2 public companies that are worth roughly $4 trillion. And I can only think back to that $1 trillion ceiling and be careful saying that $4 trillion is a limit. But it's also been a very awesome 30-year years to watch for Microsoft, for this stock. And with that, I'm going to call it quits for the week. Thanks for spending some time with me here for the Wise Investor Show. I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.